Well, it was another interesting week for the financial markets last week. A cautious 25 basis point hike from the Bank of England and a relatively dovish decision from the Reserve Bank of Australia as well, coupled with another solid US labour market report. A bit of a slowdown in the pace of job creation, but nonetheless, the US labour market remains pretty resilient across the board. That and the building theme of US exceptionalism allowed the dollar to continue rebounding, notching a third straight week of gains against a basket of peers. But the data proved a bit of a headwind for equities, which had their worst week since March, not helped at all by some rather poor earnings from Apple, the biggest stock in both the S&P and the Nasdaq. A little bit of a lighter week awaits. US inflation, the only real notable data release on the docket over the next 5 or 6 trading days. So I wonder whether markets are going to start to settle down into a little bit of a summer slumber. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get into the show. So another busy show ahead. You may notice no green screen, no studio. We are at home this week before I jet off on my summer holidays tomorrow. And I've even got my sun hat with me in preparation. Ryan Littlestone from Forex Flow Live and Forex Analytics. Good afternoon to you, mate. How are you doing?
Good afternoon, mate. If you said it was going to be a hat day today, I would have worn a wig or something. But
well,
Panama man from Del Monte.
Absolutely. Man from Del Monte. You didn't have me down as a baseball cap wearing sort of a week, did you? I mean,
I'd love to see in a baseball cap, just a bit off centre there, or even backwards. Oh yeah,
turn around backwards. Well, it would have to be an Arsenal baseball cap, of course, and we can talk about football once again. The season is back. The trophy cabinet is already filling up.
I'm done. Yeah, you go and crow about a pre-season tournament that you only qualified because no one else wanted to play in it because Man City won everything else. So, but yeah, these little trophies, these little pre-season trophies, they fill up the cabinet somewhere. Come and see us when we win a proper one.
But of course, the main man, Declan Rice, his last 2 competitive games, and he's lifted silverware in both, hasn't he? So I think it's a pretty good move on his part.
Yeah, well, we got 105 million, so we'll be the judge of that.
And you might spend some of it at some point.
Right.
We could sit here and talk football all day, but there's plenty going on in the markets, so we should probably get onto that as well in Topical Thunder. So I want to start with the institution in the background of Ryan's picture there, the Bank of England, the old lady with their latest policy decision last week. It was a 25 basis point hike, as we expected from the MPC. And it was interesting that actually there was a 3-way split on the committee with a couple of policymakers favouring a larger 50 basis point move. But there wasn't a majority on the committee for that move. And Governor Bailey himself at the press conference saying that he didn't see the case for a second straight jumbo hike at this meeting. In fact, speaking of the press conference, it was actually a relatively dovish, relatively cautious message that came across there and in the statement from the Bank of England, the MPC noting that policy is now restrictive and Governor Bailey seeming very reluctant, in all honesty, to commit to further tightening. Of course, the bank maintained their data-dependent hiking bias, saying that they would hike further if there are more signs of inflation becoming persistent and embedded within the economy. But there was no sort of explicit forward guidance that another hike is to come at either the September meeting or further beyond that. And I think this is interesting because for me, well, there's 2 takeaways, really. The first is that this is either the last or the penultimate hike in the cycle for the BOE. I know you, Ryan, have been saying for some time you reckon 5.5% is probably as high as they'll get. They're at 5.25% now, so we're not too far off that level at all. But I think the bigger takeaway on my side was the fact that we're really starting to see a bit of a script develop now, whether it's officially or unofficially coordinated among all G10 central banks, the Fed, the ECB, the Reserve Bank of Australia, now the Bank of England, all coming out with a relatively similar message, which is that we've raised rates very quickly and we've now moved them into restrictive levels. We are coming to the end of that tightening cycle. We are coming to the end, or we're coming to the point where rates will not go up any further. But the message now is shifting to one where policy is going to have to stay restrictive for the foreseeable future, and policy rates are going to remain at their current levels. And effectively, central bankers saying to the markets, don't go expecting any rate cuts anytime soon. And when you look at what markets are pricing in compared to current levels, about 50 bips of cuts from the ECB, around 140 bips of cuts from the Fed between now and the end of 2024, that looks very, very overdone in my view. And I think if we do start to see this idea, the data continue to come in as it is, central banks continuing to stick to this script, then I think you are going to see perhaps some of that loosening priced out. And I think that probably poses some upside risks to the dollar. So keen to get your thoughts on that, but also on where the BOE go next, how much more they've got left to do.
Yeah, well, we've been saying it for a while now. You know, the Bank of England, the reluctant hikers, and they reluctantly hiked, although there were still two members who wanted to go for a 50. So, was it dovish? It was usual for the Bank of England, you know, giving a bit, not shutting the door on a further hike, but, you know, talking around the goalposts that they might be close to being done. Policy is restrictive, as you say. Yeah, I'm still with my thoughts, 5.5%, at the very most 5.75%, but even I think that'll be a bit of a push now. I think they get the inflation data going their way from this month when we see that in a couple of weeks. And yeah, another central bank into, I think we can call them tops now rather than pauses, but we have to be aware of the data to come. And yeah, the market for the rest of the year is going to be trading when are the cuts coming. And, you know, that's all down to the data. I think, again, the Bank of England, the UK may see, if we get up to that 5.25%, 5.75% rates, it's going to probably put a bit more pressure on the UK economy than, you know, the same sort of levels in the US. And we're already seeing the data softening a little bit. Not collapsing, but just softening. But it won't take much to you know, tip the balance into far weaker data. And when that happens, be it the UK, be it the Europe, be it the US, you're going to see those cut trades picking up steam. So while you might think that, you know, 140 pips for the Fed might be a bit punchy now, you get two bad jobs reports or you get further data softening, 140 might be the least we're pricing in at this point.
Well, okay, that leads me on to another question then, is if the Fed cut 140, is there any economic environment you can see where the ECB do less than that? Because for me, if the Fed are going to end up loosening to that magnitude or easing to that magnitude, I should say, the ECB, given the shambolic state of European economic data at the moment, the ECB would probably end up doing a damn sight more than that, I'd imagine.
Yeah, you think so. You know, particularly with Germany looking the mess it is, being the growth engine of Europe. You know, need to call out the RAC for those guys at the moment for that engine. But yeah, it's going to be the same, and we're going to play the race. I wouldn't say the race to the bottom, but the race to neutral, if you like. The same way we played the race to the top in hikes. But I would always probably put my money. You know, if I was a betting man, I'd put my money on the US to outperform or not perform as badly as everyone else. The UK, everyone tends to think that the UK will be the worst of it. You know, every time something bad happens, bad piece of data, it's the end of the world. So the market usually goes too far overpricing negativity in the UK. And the Eurozone, I don't think we're going to see them collapsing economic-wise. I've been saying this for a while. We're probably going to see growth just meandering along the bottom, if you like. Not seeing too much negative activity. Nothing will fall off a cliff. And I think that's pretty much going to be the same for all countries. So it's just going to be a question for investors. Who do they see better yields from? And in that sense, it's probably going to be the US.
Indeed. Never bet against the US consumer, as they say, and actually more broadly, never bet against the US economy. We're going to get into the US economy a little bit because we've got inflation to get into first and then last week's jobs numbers as well. So why don't you take it away on inflation, mate?
Yeah, sure. Inflation is the big hot topic. It has been for a while. We've got the latest inflation numbers. Yeah. We've got the latest inflation numbers coming from the US on Thursday. These are the July numbers, so the first of July's monthly data. And market is expecting a rise, or the economists are expecting a rise in headline inflation to 3.3% from 3% previously. A little dip in the core to 4.7% from 4.8%. And this is the first major inflation data since the Fed and the FOMC. So it's going to potentially put the pause mantra to the test for those guys. If it comes in much hotter than 3.3%, I think that's where the market's going to get a bit more jumpy than if it comes in softer than expected. But we've got to understand CPI has been on a one-way track since the highs last year at 9.1%. That was the June reading. So, this reading, even if it is higher, will still be much lower than that. A year's worth of data that's been going one way in CPI. And this would be the first bounce since then. So it wouldn't be too much of a shock for me, too much of a surprise, in my opinion, to see that dip from 9.1% pulling up, maybe a little bit of a bounce. We've got some things in the mix with US gasoline prices. But the question is, will it be a one-off, or will it, start a bit of a trend high, another round of inflation bouncing that the Fed are going to have to deal with? And that's what I think we need to worry about, whether it's not this month, but do we see another one next month and a one the month after that? Because that's going to turn the pause trade right around.
Yeah, absolutely. And I think this is where you start to get into, does the market wake up to actually what policymakers have been saying for some time? And a lot of policymakers, Chair Powell in particular, have been saying that, we haven't made enough progress on inflation, or on disinflation, I should say. And there's kind of been two schools of thought around it. There's the school of, actually, no, you're right. If you start to annualize some of the month-on-month data on a 3 or 6 monthly basis, we haven't gone anywhere. If you look at core CPI, that's still clearly elevated. Whether it's 4.7, 4.8, or 5, you're a rounding error away from 2.5 times above the target. And then there's the other school, which is, as you said, headline CPI has been on a one-way trend lower since kind of last summer, and why can't that continue? And let's pop the champagne. We're in for a soft landing. I think this speaks to the point where actually the base effects that have been helping inflation to come lower over the last sort of 9 to 12 months, they now stop. If you look at it, the base effects pretty much net out to nothing over the remainder of this year. And I think if you do start to see a little bit of a re-acceleration in inflationary pressures at that headline level, it is not necessarily going to change the thinking at the Fed too much, because I think this is broadly in line with their rhetoric and broadly in line with their forecasts. But what I think it will do is just change the psychology within the market. When CPI printed with a 3 handle flat last month, we saw almost kind of a euphoric reaction of the inflationary beast has been slain. If we start to see a couple of months where that's ticking a little bit higher, we're likely to see the reverse of that psychological reaction, which is, actually, inflation's starting to become a problem again. And then we start to look at all of the other metrics just that little bit closer. So I think you're absolutely right. And I think in terms of the September Fed meeting, I looked earlier, the market's pricing about a 1 in 10 chance that they raise rates at that meeting. And in my mind, that just feels far, far too low. Obviously, there's a lot of data to come before then. There's Jackson Hole to come before then as well. But it just seems too low in my view.
Yeah, potentially. We get, 2 CPI reports by the time we get to the next Fed meeting. So we'll know if this one is a one-off or if it's not. And if it's not, you're going to see those rate expectations for September ramping much higher, probably up to about a 50-50 call, I think you'd see in that instance, depending on how high it bounced. If we're talking inflation 3.7, 3.8% going into that meeting, yeah, the market's going to be heavily expectant for September. But, we've seen it. The Bank of Japan, they've been expecting inflation to pull back in the latter part of the year. And so far, they've not got it. They just keep seeing the numbers going higher and higher. So, as much as they like to think they've got a handle on inflation, and we know what it's like for the Bank of England, getting a handle on anything, they're much
door handle, let alone get a handle on inflation. Jesus.
They're as much looking at the data as we are, and they're going to have to react to it the same way we'll have to.
Yes, most definitely. Well, speaking of economic data, as I alluded to a second ago, we had the non-farm payrolls number out of the US on Friday lunchtime. Payrolls rose by 187,000 on the month in July, which I must say I'm personally very pleased about, because it was very, very close to my own guess of 190. And also, I think congratulations are in order to Mr. Blake Morrow. Was he in at 189? Did I see?
Yeah, 189. And anyone who follows Blake when we do this non-farm payrolls competition knows he usually can't hit a cow's arse with a banjo. And this time he came in very close. I had my super duper model predictor, and my system carried the one when it shouldn't have. I had 287, so I was only up. I was up by 100,000. But yeah, very good call by Mr. Blake Morrow and yourself. But yeah, you win nothing.
Well, exactly. I mean, just some bragging rights. That's all. I think your supercomputer was working as well as mine normally does. But yeah, Blake and I proving the theory yet again that even a broken clock is right twice a day. Exactly that. On a more serious note, I think there were a few headlines going around on Friday afternoon, as there always are. Oh, non-farm payrolls misses expectations. Slowest monthly growth since December 21 or whenever it was. It's a rounding error away from consensus. I mean, you look at the range was something like 150 to 300. You come in 13,000 below consensus. It's pretty much bang on the money in terms of in line with expectations. And actually, if you dig into the other parts of the report, they continue to point to a very, very resilient labour market within the US. Unemployment came down to 3.5%, which is a very pleasing sign. It's a sign people are going back into work, because it came on an unchanged participation rate, which stayed at a cycle high 62.6%. There's a bit in there for the Fed hawks as well. Average hourly earnings rising by around 0.4% on a monthly basis, which gives you a yearly pace of around 4.4%. So enough in there to cause some concern about a potential wage price spiral for those of a more hawkish implication. And I think when you dig into the report, it was really only the net downward revision of about 49,000 to the prior 2 months worth of data that actually took some of the shine off the release. I guess the overall vibe I got from the report was it just fits in with this narrative of what you could call US outperformance, US exceptionalism, immaculate disinflation, whatever you want to call it. Everything we're getting out of the US at the moment points to, well, a soft landing, really. The labour market is resilient and very tight. As we've just discussed, inflation is slowly but surely coming in the right direction. And the growth side of the picture is holding up well as well. The economy grew 2.4% on an annualized basis in the second quarter. The PMI numbers, yes, they were slightly softer than expected last week, particularly on the services side, but still a decent enough pace of expansion. And I guess it comes back to what we were saying earlier. Don't bet against the United States.
Yeah, very much so. And the market reaction after the NFP was quite strange, because it was good numbers. I mean, yeah, people picked holes in it, saying it was the first sub 200k report for however many months, and the revision lower and whatever. But like you say, the range that we were expecting, it was well within target. And the rest of it, the wages coming in, stronger than expected, unchanged over the month before, 4.4% year on year. I think for the Fed, they're keeping an eye on that. If we start getting wages up towards the 5% mark, above 5%, then they'll sit up and take more notice. Solid numbers, soft landing numbers. The market had a little bit of a funny reaction. We saw yields coming off. We saw the dollar coming off quite significantly. But those moves haven't really held. So that suggests maybe a bit of summer squaring, weekend squaring, the last of the big data before we head into that summer recess period. And but as you mentioned as well, we've got the Jackson Hole event coming up, which can be a little bit of a central bank meeting light, if you like to call it. If they do have a message to give in between those meetings, that's where they'll give it. But yeah, soft landing all round, and I don't see any reason why that changes.
No, I would agree with you there. And I think you're absolutely right in terms of position squaring. I mean, you think about the last kind of fortnight or so from just before the final Fed meeting, the July Fed meeting, pretty much everyone has been short treasuries. The 10-year yield had rose, 30 basis points in that kind of 10-day period. So actually, payrolls was really the last kind of big event risk on the horizon, apart from the CPI number, until Labor Day, I would argue, in the United States. So actually, I think, payrolls out the way, cover your shorts, take some profit off the table, lock that in, put your feet up for the summer, I think would have been going through a lot of traders' minds, particularly at that sort of institutional level as the data came in.
Yeah, exactly what you're about to do, isn't it? Put your feet up and go on your holidays.
Absolutely. All I need is a beer, and then I'm in full holiday summer markets mode. And what a segue that is into your next segment.
Yeah, most definitely. But I think volatility is something we've got to look at going into the summer, and it's something we have to be aware of all times of trading. Summer is here. We might be seeing a drop in volatility. We need to know how to trade that as well. We all know that high vol gives us plenty of market moves, but when vol drops, it can make for frustrating markets, and not all summers are the same. We've just come through, plenty of volatility over the last few years. We had the COVID blip and the follow-on after the COVID blip. But markets are different to the old days. Where usually summer months would see a lot of institutional traders heading off for their breaks and their vacations, if you like to put it in American terms. But there's less and less traders on desks nowadays. It's all down to the machines, and we know machines don't take holidays. So summer isn't like it was in the old days, where, as I say, traders, fleeing for the golf courses. So it does keep the markets moving over. But however, what it does do is it takes away that human approach. So if you do get volatile moves and the machines are all jumping around on it, that can give you, if you like, increased volatility, and then it drops off a cliff and it goes quiet in between the data points. And now when I judge volatility, particularly for FX, I like to look at the 1 month at the money option vols. They give you a good rule of thumb, a good broad look at volatility. And currently, if we look at a couple of pairs, euro dollar, for example, volatility 6.68%. For cable, it's 7.59%. For dollar yen, a bit higher, near 10%, 9.8%. And for something like euro sterling, 5.35%. So vols above 7 to 8% mean we're going to get decent sized moves. You can see that from dollar yen after the NFP on Friday. But if you get volatility that's less than 6%, down towards the fives, means things are going to be much quieter. And that can make things slower between events. So, we've seen a bit this morning, not really any big moves going on in pairs like euro dollar, euro sterling, all pretty quiet. But then you get a big data point, you get an event headline, and boom, you get a sudden spark of volatility. So what low volatility does do, it can reinforce the ranges. So if you're looking at trading markets, you may need to have a lot more patience, pick your levels, wait for them to happen, wait for them to come, because those bigger levels are likely to hold in a low vol environment. But summer is definitely not a time to go chasing prices and chasing trades.
No, absolutely. I was about to make that very point, which is, the absolute worst thing to do in a market that is very, very low and very, very quiet in terms of volatility is to start going to chase things, particularly during summer when liquidity is that little bit thinner, and actually that you can be liable to see prices swing around on not particularly much. That's the time when going to try and chase trades that aren't really there is going to end up, you are going to end up burning yourself. And I think really for me, if the market gods are listening to the trade-off this week, just if we could have a quiet couple of weeks, that would be absolutely great. Then I'll have a little amount to catch up on when I get back.
Yeah, well, we'll see if you're a good indicator. Again, Blake is another volatility indicator. When he goes on holiday, usually vol blows through the roof. So, yeah, we'll see if you're the same or you're the opposite. It dies when you go away.
Fingers crossed for both of our sakes. I'm the opposite.
We'll get some new volatility measures. One called the Blake effect and one called the Michael effect, and we'll see which one's better.
And we'll net each other off. Right, let's get in some charts in That's a Setup. So I want to start with cable this week. I mentioned the Bank of England and the slight move lower that we saw in the pound a little bit earlier on, but let's put some levels onto that. Cable has continued to roll over. Obviously, we printed those 131.40 cycle highs in mid-July, and spot now trades just in the sort of mid-127s, rather rather amusingly, I think spot is now back to as near as makes no difference it was when I first went short cable. So I only had to go, 4 big figures underwater to finally be proved right on that view. I think this speaks to the point you were just making, Ryan, actually, around the ranges that can reinforce themselves over summer, because cable had a little brief foray below 126.70, the next support last week, but couldn't break through it on a closing basis and pop back above very quickly. And then we've got the 50-day moving average above, which is around 127.5, and then the prior ascending trend line at 27.75 and 28.5 resistance above that. And you just start to look at this and you think, actually, this could start to move sideways for a little while now. I'm still bearish on sterling. I think the mortgage cliff that is coming up is going to have a more significant impact, both in terms of limiting the degree of further tightening from the BOE and also on reining in consumer spending and denting economic growth than markets currently expect. But that's probably a theme for the autumn. So I think for now, this kind of 26.70 to 28.50 range is likely to remain relatively firm. But if you put a gun to my head and said, where does this go over the next 3 months? I think the 100-day moving average at 125.90 is going to be firmly in the bear's sides.
Yeah, this is one, and a lot of pairs are looking similar. A lot of assets are looking similar. It's trends within trends. You've got the longer term trend, which is up, and that still remains firmly in place. But the shorter term trend off those highs, we keep creeping lower. Lower highs, lower lows, just edging down. So I think there's enough here for both sides to play. 130 was a level I was looking at last week, or perhaps a week before, when we hit that as a potential stall point for that particular move. We hit that pretty much nail on the head, and it's been down ever since. As you mentioned, we've got that little bit of an extension through your 126.70 down near the 126 area, which again was another level in itself. It held there. So this is what, as you said, alluding to my last topic, is that you get the ranges setting up. So now you know your 126.70, 126 is your downside area, your 130 is your upside area. Sit back, play the range, and you know what to do if the range breaks. So, you don't need a bias for that sort of trading.
No, exactly that. Right, what about gold? Are you going to give us a little rendition of the Spandau Ballet song before you get on to the analysis?
No, we used to have that. We had 2 players called Carlton Cole and Joe Cole, and we used to sing that song at both of them. So it was multi-purpose for those 2 players. Rinse and repeat, as we like to say. Gold we spoke about, I think, a couple of shows ago now, and it had a nice run up through July, and it topped out pretty much at the 50 fib of the May drop. We've been down to test the former resistance area turn support around the 1930s. Had a little bit of a blow through, a bit like cable at the 126.70. Sometimes you get that little extension through. So had that blow through down there, but we got back pretty much quickly above that 119.30s area. And we're looking to perhaps hold it once more, might make a bit of a firmer go of holding that support than it did on Friday. And if we can hold this area for a good period, a good few sessions, then the buyers are going to be encouraged to come back in, get the move and maybe push it back up again. But if we break this 1930s area, we're likely to see a run down to the 1900s. Again, in the bigger picture, it's a trend within a trend. The bigger price trend has obviously been higher. We had that move up to, the 2000s. And then we've just seen the price come off from there. So again, we're perhaps looking to match off 2 trends against each other. What the bigger trend's doing against what the smaller trend's doing. But while we hold this 1930, I think, we get a push up. Where it goes to, I don't know if we get up to that 1980s high again. Be interesting to watch around 1960. If we find a bit of resistance back into that zone, that'll keep the short-term bearish pattern in play. Then perhaps we have a look down towards those low 1900s.
Yeah, it's an interesting one. As you said, it's another one of those kind of trends within a trend. I'm struggling with gold at the moment a little bit because I'm really struggling to work out what's actually driving the yellow metal. I mean, is it risk appetite? Probably not. The S&P was quite chunkily lower last week, and gold didn't really benefit from that too much. Is it yields? Well, maybe, but actually you could argue probably not, given that particularly on Friday, Treasuries found quite a nice bid and gold really couldn't do so. Is it the dollar? maybe the FX is kind of going sideways, and gold is within a range as well. But as you well know, I mean, whenever there's sort of an uncertainty over whatever the fundamental driver of an asset is, it just makes me a little bit cautious to take too much of a high conviction view. So certainly when it comes to gold at the moment, I'd be looking to just sit on the sidelines, wait and see what pans out, see if one of those three key drivers can re-establish itself on a correlation basis as the main impetus behind vol in the yellow metal. And as and when it does, and as and when we get near those levels that you've marked up, that's when you can then look to take a position. And I think that really epitomizes how to trade these summer markets.
Yeah, exactly. And, correlation is a big subject of your next slide, talking about US oil.
It is. Go on. You've done. We're smooth this week, Ryan. Aren't we? Shane Kyriakos isn't quite as smooth to move the slides on. Sorry, mate. So, as you said, yes, the bullish momentum in crude continuing last week. This is WTI, although the chart looks very, very similar if you look at Brent. On the fundamental side, we're still getting output cuts. Saudi, Russia, a few other OPEC Plus members extending their output cuts into September. I think that was very much expected by markets, particularly if you read some of the sell-side commentary that's come out since the announcement. What was perhaps more of a surprise was the fact that everyone was stressing they're prepared to do more to balance the market if required, which is why I think that announcement had more of a bullish impact on the market than you may otherwise have expected. But we have run into, well, as I've called it there, a bit of a brick wall really at this 83.50 level in WTI. We tested it on Thursday, we tested it Friday, we tested it again today, and we just haven't quite been able to break through it just yet. So I wonder whether we're going to see a little bit of profit being taken off the table here. Obviously, outside of the United States, you've still got some concern lingering around the rather dismal state of the manufacturing sector, and particular concern around the lack of any notable economic recovery in China, which I'll get onto in a moment. If we do see some downside, I think 81, 80, 85 is probably the first level to have on the radar. But if we can get a closing break above this 83.50 level, then 84.50, and then maybe even all the way up into the 87s is going to be firmly in the sights of the bulls. And as you said, in terms of correlations, in terms of the implications of this for other asset classes, you got to remember, crude isn't just something that you can trade. It isn't just a futures contract. It isn't just a barrel of black stuff that is used to power the global economy. The price of oil has a significant impact, both in terms of inflation and in terms of economic growth. And if we were to see WTI continuing to rally as it has done, then that could start to pose headwinds in terms of economic growth. And it will also act as an inflationary force as well on the global economy. And just as we start talking about this idea of immaculate disinflation, a surge in oil prices is probably the last thing that any central banker wants.
Yeah, very much so. And you've also got to remember the FX implications, because for heavy importing countries like us in the UK, the value of the pound makes the rise or the movements in oil either doubly more expensive or on occasion even cheaper. So, and it can negate some of the price move. So if cable continues higher while we see in oil rising as well, then there's a bit of a zero-sum game there, because obviously we're getting more dollars for our quid, so we can buy that oil. But that's a subject we could probably do a whole show about. But as far as oil's concerned, I mean, this was one of my charts last week as well, so I'm glad you've copied most of the headlines in it. Might have been an easy one for you. But the 82.50 was an area that I was watching closely at the top of the range. We've broken through that, but as I said, did need to clear that 83.50 area, which it hasn't done as yet. So we're not out the woods just yet on whether this rockets high. But I think, if we get a breakthrough here, we're probably going to see the 90s at some point.
Indeed. Imitation, Ryan, it's the sincerest form of flattery, as I'm sure you're aware.
Well, call it what you like, mate. I'll call it copying.
I'd just call it theft, to be honest.
Well, I was being polite. But,
Right. What about dollar MEX? Where's that headed?
Yeah, dollar mex. This one's been in the limelight a bit because we've had a big bounce, and this has been one of the big carry trades of the last year or so. And again, this one I'm just going to look at purely from the text. It looks like it might have finally stopped falling through the floor. It's been, pretty amazing how far this has gone, a one-way street. So we built a bit of a support base around the 1670, 72 area, which has led us to bounce to 1740 once again. Now, with Bank of Mexico, Banxico, signalling that they're done with rates, and we've got a meeting from them on Thursday. And they said that even if the Fed hikes again, they're likely to stay on hold. So that's another central bank who's in pause or at the top in rates. And then we've got the Fed on top as well. The market is wondering if this carry trade party is coming to an end. Now, we can see why the 1740 area is so important. It was support on the way down in that big move. Didn't last very long, but support nonetheless. And it's been resistance on the way back up twice now. So technically, we know our battlegrounds. We're speaking about ranges and trading ranges. Well, here you've got a decent range as well. And what I like about this chart is that it gives us two clear points to trade, two trading opportunities. One, play the range between 1670, 1740. Two, play the breaks on either side. So again, this is one of those times where the bias doesn't matter. It doesn't matter what you think the market's going to do. We've got two areas to trade. All we need to do is trade the levels.
Absolutely. Very well said. I think, excuse me, this idea of carry trades actually just more broadly, is it coming to an end? I think there's a decent case to say that it might well be. I mean, if you look at both sides of the coin, you've got, the Bank of Japan, for example. Everyone has been selling the yen as a funder for carry trades. They're now starting to turn a little bit more hawkish, obviously tweaking yield curve control and looking to slowly but surely normalize policy. And then if you look at the other side of the coin in terms of what you'd be buying for that carry, we had a rate cut in Brazil last week. I think the week prior we had a rate cut in Chile. There's some expectation that the Banxico in Mexico go in a similar direction before the end of the year, as you alluded to. So actually those yield differentials, those spreads are going to start to narrow. They are going to start to tighten. And then as your chart shows, these carry unwinds can have a long way to go, and they can be pretty brutal if everyone tries to get out of them at the same time, particularly if we see some of those key levels begin to break down.
Yeah, very much so. But I mean, if you're always going to get your short-term panic merchants, maybe the ones who got in, down near the bottom here, trying to jump on the carry for the last few legs. They're going to be the ones that fold first. If you were short from the 20s, you're not going to worry until we get above 18, even 19, before you start thinking the carry trade is over. Because although you're giving some back on the FX side, if you're not hedged, you're still going to be earning the carry in real rate terms. So it's got a long way to go. Again, fibs is what I use as a measure of the trends, and the 38.2, as you can see up there, is well up near 19. So huge amount of distance to go yet, but all trends start somewhere. So a bit like we've been talking about inflation, and it's been one-way road, so is this pair. That doesn't last forever, so maybe this is time for the bounce. But if you're going to trade it, fine. Look for a break of 1740 if you want to get long and potentially ride that higher.
Absolutely. Wait for the level to break, and then it's time to take the trade. Perfect. Well, let's get on to our plays of the day. Right. Well, having been accused of theft with my last chart, I think I'm going to be accused of theft once again with my final chart this week, which is looking at the Aussie dollar. My colleague, our rival on the slightly worse version of this show, Mr. Weston, showed a similar chart to this last week when he was discussing with Blake Morrow. But I want to dig a little bit more into it because the Aussie dollar made a closing break below the 65.80 mark last week, the purple line on the chart there, which has been very long-standing support all the way back since March. Of course, when we last broke below it in May, we made those two lows and then rallied and rebounded relatively quickly, forming that double top around the 69 handle. My play of the day this week is to get short the Aussie dollar. If you look at what's going on down under, things don't look particularly great. The RBA are taking on a very dovish, very cautious tone. It looks like they may have one more hike. Probably they are looking like they are done, and that other hike won't materialize, particularly with the governor changing over in September. Other things that are working against the currency, well, you've got the fact that it seems to have decoupled from risk assets. When the S&P was notching weekly gain after weekly gain after weekly gain, the Aussie dollar was just rolling over and heading ever lower, as you can see. And of course, the S&P had its worst week since March last week, and the Aussie dollar continued to roll over. You've also got concerns about what's going on in China. The economy's slowing and just not really recovering at all. More and more stimulus coming, but the Chinese authorities are frankly pushing on a string at this point. And the other thing to note is seasonality. If you look at the average performance of the Aussie dollar over the last 10 years, between now, roughly, and mid-October is the worst period of time of the year for the Aussie dollar. Now, don't use seasonality on its own as a trading signal. I certainly wouldn't, but they have been one of the best signals and best sort of contributory factors to trading decisions on a year-to-date basis. So my play of the day this week, I'm looking to short the Aussie dollar, initially targeting the 65 figure, and then below that 64.60, above 66.5, then I'd be looking to reassess things. Mr. Littlestone, what about dollar CAD?
Yeah, dollar CAD for me. This is a trade that I've been in since around about 131.50s, and it's looking fairly bullish still, following a decent bounce from 131. This one had the last dip into month end, and that's where I jumped into longs. We've hit some solid resistance now in this 133.90, 134 area, which has also been a prior top recently. We've had a go up here for nearly 2 days now, and the pullbacks have been fairly shallow, which suggests we're setting up for a break. I'm going to look to add back into longs on a break of 134, maybe one sort of 134.15, 20 area. And I think if we get a blow through, we could see 135 pretty quickly thereafter. What I like about this trade at the moment is that it's moving without the oil influence. You know, CAD is moving without the oil influence. Usually you'd see CAD strength when oil's rising, but it's not doing that at the moment. And I think that might change if we do get this blow through in oil as well. If that breaks the 83.50 area, it will break out of this long-term range. And then I think the loonie is going to pay a bit more attention to what happens. Doesn't necessarily mean it's going to stop going high, or the pair's going to stop going high. Just means that the brakes may be applied a little more strongly on that oil break. But, if we don't break after, get to Wednesday, maybe we haven't broken then perhaps you're going to see the longs, short-term longs, packing up their bags if they're not going to get the break, and the shorts reasserting themselves. Maybe we get a push down to 133 again. But hopefully this trade will last until you see the show on Tuesday, because we've been knocking up 133.99 has been the high today. So fingers crossed this lasts until we actually get to see the show.
Well, if it doesn't, then we all knew what you were doing in advance. Brilliant. Well, that does bring us to the end of another week's show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. All three of us will be back again in a week's time. If you've enjoyed the show, please leave a like on the video. Drop a comment as well. Let us know how you're trading the markets, or if there's anything that you want us to have a chat about next week. And we will all see you again this time next week. Thanks for watching, and goodbye for now.